Hey guys, how's it going? Lee here. Now I was scouring through the internet to try to find a topic to write on for this video, and I found a study in 2017 that actually showed how few Australians had invested overseas. The numbers are going to surprise you. Now whilst it's good that about 31% of Australians invest in equities or stocks, the remainder I imagine probably either invest in real estate or, their retirement accounts. Now of that, only 8% of investors actually invest in stocks or equities overseas in foreign stock exchanges, which makes up about 25 to 26% of all shareholders in Australia. Now to me this number is rather low, so in this video I wanted to tackle the pros and cons of relying on home bias and investing in just Australia, and then give the other perspective or the other view of investing abroad and the benefits that can come along with that as well. But of course, before I continue going into the study, looking at some of the numbers and the pros and cons, if you could just take a second to smash the like button down there, it'd be greatly appreciated. It greatly helps out this video. And if you're not subscribed, why not? Just hit the subscribe button whilst you're down there also. Anyways, let's get into it. Yes, that's right, currency fluctuation. It's a big factor because, well, this is an Australian $100 and this is a US $100. And for you to trade, invest in another stock exchange, you're gonna have to trade your hard-earned Aussie dollars over to the US equivalent. Now, whilst this does seem like, well, a no-brainer, of course, if you want to invest in another stock exchange overseas, you're going to have to exchange your Australian currency. But what this does do is it introduces friction to trading and investing over in another country. And for many investors, that's enough to deter them away. That's enough for them to say, oh, it's too much to think about, because let's give an example. Let's say you've got 10,000 Australian dollars, 20,000, 30,000, whatever the figure is. Let's make it 5 figures so there's a little bit more on the line. And you're ready to invest abroad, but then you go, wait, is my $10,000 or $20,000 going to be worth more today or tomorrow? What about in 2 days? 3, 4, a week's time? What's Trump doing in the US? What are we doing in Australia? A lot of these macroeconomic things that can affect and fluctuate the Australian dollar positively and negatively, which plays on a lot of investors. And I've personally gone through this myself, and it is not something easy to do, but it is just part of, well, doing business. You are gonna have to take on some risk, and yeah, that's one part of it. Now, another reason why you might invest in Australia is that, well, we understand the economy, we understand the businesses, and we're very familiar with some of these brand names. Think of your Woolworths, which is where I got these Buy and Bake cookies from. Think of your Commonwealth Banks, BHP, all these other big brands that we see everywhere in Australia, right? That develops our home bias. Honestly though, if this is the reason why you are not investing abroad or just don't even want to think about it, there's so much information out there on the internet. On YouTube, you can go on social media like Instagram now even has investing pages, and most of them are American. So it's actually not that hard to find information on companies abroad and be very familiar with the economics of another country, especially one like the US, where there's so many news corporations that are publishing things around the clock. And to be honest, in terms of the services and the products that I use, nearly all of them are American. There are very few Australian products or services that I actually use, apart from the ones that I just have to use every day. But I mean, my iPad, the monitor, my MacBook, everything that I use is American. And I would go as far as saying if you pulled the top 500 American companies and the top 500 Australian companies, I probably know more American companies than I do Australian companies, just due to the type of media that we consume and what we use on an everyday basis. In saying all of this though, I understand that home bias is such a strong thing, and there are a few more factors like your currency fluctuation and what we're gonna go into next that really leave people with a lot of confidence and comfort in investing in just Australia. Now the last benefit for investing domestically, and if it wasn't for this, well, I don't think a lot of Australians would actually invest in Australia, is the high dividend payout, which then allows us to live a certain lifestyle. Whether you're surfing about, lounging about, or taking on your passion that might not pay as well, the dividends help a lot of people sustain their lifestyle. And luckily in Australia, even if you invest in the average index fund or a listed invested company, that's called a LIC, you can expect to get a dividend return of about 3 to 4%. Let's call it 3 to be conservative. Now that's a solid return when you're comparing it to savings accounts, which are getting a lot smaller and smaller, and even more so as cash rates continue to decline and we continue to print even more money. But also the dividend payouts are relatively much higher than other stock exchanges around the world. Look at the US, where the dividend payout might be 1 to 2% or so. 3 to 4 looks very, 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 very attractive. But honestly, I think Australians in general just love cash flow, and it might stem from our love for property, you know, receiving rent, but instead we're receiving dividends, and now you don't have the headaches of like a building breaking down or like a tenant causing damage to your property or anything like that. So dividends are just a much cleaner way, and they've also got franking credits attached to them. So for people who don't know, basically you just pay less tax because the company's already paid it for you before you receive the dividends. That's another video. Now with a lot more people starting to understand how franking credits and dividends work through online forums and mediums, seeing videos and whatnot, a lot more people are heading towards the dividends route in Australia just because they want to work less and have more of a comfortable lifestyle. Which is why we've seen an explosion in the FIRE movement, that's Financial Independence Retire Early, popularised by our very own Aussie Firebug in Australia and Mr. Money Mustache over in the US. It's all about living on very little, being able to invest conservatively into an index fund, an ETF, anything like that, and having that compound over time, and one, having that pay you dividends that will, you know, sustain your lifestyle. Or number two is drawing down from the capital and then using that as a form of income to also sustain your lifestyle. Now, given the hype of the FIRE movement and a lot of millennials moving towards that route, it's no surprise that a lot of younger people are becoming a lot more conservative with their investments, which is contradictory to what we get told. You know, your risk appetite should be huge when you're a lot younger, and it should slowly wean off as you get older. And so individual stock picking or high risk, you know, investments, and then slowly wean towards ETFs, LICs, index funds, bonds, gold, whatever it is, something more conservative that will sustain your wealth as you retire. But instead, what this report shows is that 80% of young investors would much rather get a guaranteed return, which in Australia is rather slow and steady, bolstered with some nice dividend income, which we were just talking about. Okay, so now knowing that we can make money through capital growth and dividends through investing in Australia, what's the draw for investing overseas? Why should I go and put my hard-earned Australian dollars overseas? Well, one of the first and most obvious reasons is the fact that Australia makes up about 2% of the whole global market. 2% of the global market. And you can see on this list here, it's in line with some of the Asian countries, with America having the largest portion at 44%. Now just have a look at all the other markets that are on that image. There's so many markets out there that I've never even knew existed prior to, you know, looking overseas and looking abroad, because we have our ASX, our Australian investing lens on. Now to contextualize this whole thing, I want to be very clear that just because the market cap of the entire stock exchange is much bigger like it is in the US, it doesn't mean that you can just throw money into that pond and, well, you're gonna get a lot of money right back at you. Unless you invested in the worst time during this whole Rona situation, then you probably made money no matter what you invested in. But what this does go to show is that a market like the US has a greater addressable market. Now speaking of the addressable market, that's something that I don't hear a lot of people talk about. Just think about the biggest companies in Australia. You're thinking Woolworths, you're thinking Big Four Bang. They, for the most part, address the Australian population. They provide products and services just to Australia. And so although they do have some form of reach internationally, it's very, very small. And in Australia, well, we only have what, 25 to 30 million people in terms of population. That's not a large enough addressable market. Now contrast that to overseas companies, even in the UK or in the US, we are talking about Apple, we're talking about Unilever, we're talking about Nestle, we're talking about Microsoft, we're talking about Amazon. All of these global international brands and businesses that operate on a much larger scale, bigger and broader than the US alone. And so their revenues can continue to grow and grow and grow as they bring on more products and services, or are able to leverage technology to do things in a more efficient manner. Now, apart from making lots and lots of money, potentially from investing overseas in a bigger market, another reason why you might want to invest overseas is because you want diversification. And by investing abroad, it allows you to hedge against geographical calamities or currency fluctuations, which can swing either way. So it could be a good thing, it could be a bad thing. But we kind of want to make sure that if it is a bad thing, we have an insurance policy by investing somewhere else around the world where the bad thing isn't happening. And if you're still unsure, here's an example, right? So let's say you're investing in the US and the Trumpsters causing all kinds of issues abroad, domestically, there's protests and whatnot going on. And the stonks are no longer stonks, they're just stocks, not performing that well. Now that's an example of when investing abroad might not be such a good idea, but when it is, and this is when the diversification might kick in, is say for example the Aussie dollar goes down, your stocks you held are in the US, or currency that you're holding because you've converted it over is in USD. You've now sell down your position in the US, and once you convert it back to Aussie dollars, you're going to get a much larger value. Now at this point, if you're still unsure, this next part might provide you with some clarity, maybe reassure you on investing, just continuing doing it domestically, or maybe going abroad, right? Let's get into it. So I'm not sure about you, but I love graphs, and here's an example in a graph from Philo Capital in Australia that shows over 100 years the returns with dividends invested from the US and in Australia are very similar. But there are a few things to know. First, in the graph, it assumes that these investors are investing domestically, so there is no exchange in currency, which is something if you're an Australian investing overseas, then there will be exchanges. But instead, what they've done is given each investor from the US and Australia $100 each to invest in the 1900, with the Aussie shares following the All Ords and the US shares following the S&P 500. Now, whilst both hit the 148,000 mark in the end, both have grown in very different ways and for very different reasons. Now, the big key difference between these two countries is how they got to where they got to. For the US, only 1/3 of their economic growth has come from the growth in population, which is just more people producing the same level of output. Whereas in Australia, 2/3 of our economic growth is related to population growth, which is not ideal because to continue such growth, we need more people coming in. And from my, well, what's it now, 20 years of being in Australia, I don't think that's a very popular sentiment. And so now that we know 1/3 of the US comes from population growth, where does the other 2/3 come from? Well, it comes from increasing productivity, which in contrast to population growth, where everybody is producing the same thing at the same rate, we are now getting more output per person. So instead of relying on a population growth to provide more services like finance, health, and education where you can pump your money towards, countries like the US rely on innovation such as technology to gain a higher output per person, which is why we see such high valuations on tech companies, because their scalability and reach is endless, as opposed to a market like Australia where many of the big companies are dependent on just a portion of the domestic market. And you don't have to look or think very hard to see examples, right? We think of our banks. Well, banks provide loans, and to provide loans, you need people who want or need loans, right? And that comes in the form of housing. And so for housing to have a high demand, you need a lot more population or a possible stimulus package to come on through to provide grants to produce that demand. And so without that manufactured demand, there is going to be very little to no growth unless the population increases in Australia. Now guys, at this point, if this video has encouraged you to invest abroad, how are you going to do it? So generally, if you want to invest abroad, there's probably about 2 ways to do it. The first way is to pick individual stocks or go abroad and invest in maybe an index fund over in the US that follows the S&P 500, or if you want to invest in Apple and Tesla or anything like that, you can just go and buy those individual stocks. A lot of the big banks will have trading platforms that will allow you to do so. It's a lot more complex than investing just domestically, and I'll go into that in another video. Not for this video, it would go on for like 40 minutes. The next way you can go about investing into international shares is by doing it domestically. There's a lot of ETFs that will track very particular things over in the US market, over in the Asian markets, over in the EU markets, which I probably wouldn't delve into. They've got all kinds of problems over there. But yes, various ways for you to invest abroad, either more directly, which probably gives you more of the gains, or you can do it more passively and indirectly while still doing it within the Australian framework in the ASX and also trading within Australian dollars. But anyways guys, that's it from me. Leave your comments down below. Have you invested in shares overseas? Are you considering it, thinking about it? I know this is a heavy topic. I hope you guys got a lot out of it. If you made it to the end of the video, leave me some Apple emojis. Just put some Apple emojis below to show your support. I greatly appreciate it if you made it this far to the video. Remember to click the like. I'll catch you guys next time. Have a great rest of the week.